You'd think buying a slice of Microsoft, Alphabet, and like India's fastest growing energy disruptors requires a global brokerage account and a massive pile of cash.
Right, yeah. Or at least a trust fund.
Exactly. But what if I told you it takes exactly 9,500 rupees? Welcome to our deep dive. Today, we are looking at a highly specific mission. You have a starting budget of 9,500 rupees, and you want to maximize long-term wealth in the Indian market without hitting those usual high entry barriers.
It's a tight budget, but it's totally doable.
Okay, let's unpack this. How do we take this, really tight capital pool and strategically deploy it so it actually moves the needle?
Well, the analysis points to two distinct allocation frameworks tailored specifically for this 9,500 rupee constraint. It essentially breaks down into strategy A, which focuses on aggressive wealth acceleration, and strategy B, which leans into core balanced growth.
But before we pick one, we have to look at the anchor they both share, right?
Yeah, exactly. Because no matter which path you choose, the first 4,500 rupees goes to the exact same place, and that's the Parag Parikh Flexi Cap fund.
Which is like this foundational bedrock, right?
It really is. Instead of being locked into a specific company size, it operates almost like a financial chameleon. I mean, it dynamically shifts its weight between large, mid, and small cap stocks based entirely on intrinsic business valuations.
So it only buys in when the underlying financial health makes it a bargain.
Spot on. And right now, that mechanism naturally pulls it toward heavy exposure in domestic financial services and consumer cyclicals, where the cash flows are highly reliable.
I mean, to me, this fund is basically a financial multi-tool. And this is where it gets really interesting for a domestic investor. It historically holds a tactical allocation in international equity, right?
Oh, yeah. That's the secret sauce. Through this single Indian mutual fund, you're grabbing pieces of U.S. tech giants like Microsoft and Alphabet.
Wait, really? So you bypass the whole headache of international taxes and foreign brokerage fees entirely?
You completely bypass them. And that structural efficiency is just crucial when your total budget is under 10 grand. You establish domestic stability while simultaneously capturing, that global tech upside.
Wow. Okay, so if the foundation is identical for both strategies, the actual divergence and the real risk kicks in with where you allocate that remaining 5,000 rupees. Let's look at the high-octane route first. Strategy A.
Right. So strategy A pairs that foundational fund with the quant small cap fund. Now, this is where the mechanics get pretty aggressive.
Aggressive how?
Well, it operates on a proprietary quantitative framework called VLRT. That stands for valuation, liquidity, risk, and timing. Instead of a human manager like falling in love with a stock, this uses a quantitative algorithm to ruthlessly swap sectors based on momentum.
Oh, wow. So if a sector loses steam, the algorithm just drops it immediately?
Immediately. No emotions attached.
Wait, aggressive rotation based on an algorithm? I mean, for someone just starting out with limited capital, that sounds like a recipe for getting whipsawed. If I only have 9,500 rupees, shouldn't I be anchoring my portfolio, not jumping in and out of trends?
Honestly, it absolutely should terrify you if you have a low risk tolerance. This isn't a buy and forget fund at all.
Yeah, that makes total sense.
The algorithm is currently chasing high momentum sectors like energy, financials, and metals and mining. It targets market disruptors capable of exponential scaling, which inherently makes it a high beta asset.
High beta meaning its price swings will be significantly more extreme than the broader market, right?
Exactly. In plain English, you need an unyielding multi-year holding capability to survive the drops. If you panic and sell when the algorithm hits a rough patch, this strategy will shake you out and completely destroy your capital.
Yikes. Okay, so if strategy A is this momentum hunting algorithm that comes with massive swings, how do we build a portfolio for the investor who wants growth, but physically cannot stomach seeing their portfolio values suddenly drop in a bad month?
That is exactly where we look at strategy B, or core balanced growth. Instead of chasing momentum in small caps, you deploy that remaining 5,000 rupees into the Mirae Asset Large and Mid Cap Fund.
Okay, and the mechanics here are entirely different.
Totally different. This fund legally mandates a minimum 35% allocation to stable Nifty 50 market leaders, and then another 35% to high-growth mid-cap compounders.
Wait, so by mechanically locking 35% of the capital into those massive Nifty 50 giants, Strategy B is essentially buying a giant insurance policy against the mid-cap volatility.
That is its exact function, yeah. Because of that strict mandate, you naturally get anchored in defensive sectors like pharmaceuticals and information technology.
So when the broader market takes a hit, those stable cash flow sectors just act as a shock absorber.
Precisely. You still capture the operational growth from the 35% mid-cap allocation, companies in sectors like automobiles that are expanding rapidly, but your floor is much, much higher than in Strategy A.
So what does this all mean when we put the pieces together? Strategy A chases exponential growth through an unfeeling algorithm, accepting wild volatility. But Strategy B builds in a shock absorber to protect your downside.
Spot on. And the best part is that both accomplish this with incredible cost efficiency. By using direct plans, these strategies have expense ratios hovering around a mere 0.60 to 0.70%.
That is crazy low.
It is. Structural cost minimization is just quietly working in your favor here, keeping more of your money compounding over the years. So the only real choice you have to make is assessing your own psychological tolerance for short-term losses.
Which leaves us with a really fascinating shift in perspective. If a mere 9,500 rupees can seamlessly unlock algorithmically managed momentum, global tech monopolies, and built-in market shock absorbers, what does that mean for the traditional belief that you need significant wealth just to start investing properly? Maybe the velvet rope keeping you out of the market was just an illusion all along.